ಎಲ್ರಿಗೂ ನಮಸ್ಕಾರ. Hearty welcome to Jnanarjane Empowering Excellence. Friends, today we have a very interesting learning session on the topic the latest changes in GST effective from January 2022. Friends, to enlighten on this topic, we have a very young professional, CA Akshay Hiregange is with us. On behalf of Bangalore branch and on behalf of all the participants here, hearty welcome to CA Akshay. Hearty welcome, Akshay.
Thank you, sir.
Hearty welcome to branch secretary Divya. Participants, you are the reason for this program. Hearty welcome to each one of you. So I'm sure this GST is a good number of practitioners are doing the practice of GST. As there are a lot of changes effective from Jan 2022, we thought it to have a session on that. So I'm sure you are going to enrich at the end of this 2-hour session. Hearty welcome to each one of you. I'll take a minute or two update you about the upcoming program. In the month of February, we have 2 important programs. That is, the first one is on 2nd February 2022. It is on Wednesday, 2nd February. 1st February is being the union budget. So it is a practice of Bangalore branch to have a budget analysis on the next day. So this is going to be a 29th awareness program, analysis of union budget 2022 on 2nd February 2022, 4:45 p.m. to 7:30 p.m. So I request all of you to register that program. The panelists are Professor R. Vaidyanathan, Mr. Sharath Sharma, co-founder iSpirit Foundation, Dr. Soumya Kanti Ghosh, Group Chief Economic Advisor of State Bank of India, V. Lakshmi Kumaran, founder and managing partner, Lakshmi Kumaran and Sridharan, attorneys from New Delhi. And this program is moderated by CA TV Mohandas Pai and CA H. Padamchand Kincha. So this is going to be the 29th awareness program of analysis of union budget. So I request all of you to register that program. And class by class analysis of union budget is going to happen on 11th February. That is a full day's program. So it is again on a hybrid mode, available both physical and virtual on 11th February 2022. Whereas the union budget awareness program on 2nd February is going to be the virtual. So I request all of you to register for both the program. In addition to that, there are many other interesting programs lined up in the month of February. I request all of you to register and visit bangaloreici.org and register that program. And one more information for the awareness of members. Today, we have in the branch, new managing committee members are got elected. 9 members got elected today, and they are going to take charge on 21st of February. With that note, this time it's a unanimous, there is no election. So unanimously, 9 members got elected for the Bangalore branch. So once again, hearty welcome to each one of you. Over to Divya.
Thank you, Chairman. A very warm welcome to all the participants and to also the speaker of today's program. To give a brief introduction about Mr. Akshay M. Hiregange, he is qualified as Chartered Accountant in the year 2016. He is partner of the Audit and Assurance Wing at a multi-locational firm in India. DISA qualified in the year 2021. He has experience of over 3 years in internal audits, compliance and assistance and internal taxes, indirect taxes, and in the past 5 years, directing focus towards GST, including audit and consultancy matters. He has headed GST impact assessments of various industries and also has taken GST trainings for corporate clients and been invited by ICA as a speaker on GST on multiple occasions, co-author of Due Diligence Under Indirect Tax booklet, also is member of Study Circle Artha, a regular contributor of GST articles and also replies to KSCA, a CA club
Thank you, Divya. You got cut for a moment over there.
Yeah, some signal issue. With this very brief introduction, I wholeheartedly welcome you for today's program.
Okay, thank you, thank you.
Yeah, over to you.
Yes, I'll just share my screen. So the changes coming up in January 2022 were more focused upon making the GST law even more stringent, even more tough for the smaller and the medium enterprises to follow, and has been a result of the various frauds, fake invoicing, and the non-registration of various entities who ideally must have been registered and are not paying the taxes under GST. So to bring all these persons into check, these changes have been brought into GST. There have been some rate changes, and majorly the biggest change, if we all see, is in relation to the restriction of ITC, where they have linked it directly to the GSTR-2B. There are, of course, many issues we'll be discussing in our upcoming slides. But before that, some of the things which I feel we all need to be aware of is that the amendments which the government is bringing in should ideally. Hello?
Hi.
Sir, can you please mute? Thank you. So, coming to the amendments which are being brought in, the implication or the understanding which is coming out is that the collections are being focused upon and not really the economic growth of the country. And the constitutional body, which is our Apex GST Council, they are unable to validate and send back certain proposals and ensure that they are in the right spirit, and therefore whatever has been suggested by the tax officers are being implemented at the end of the day. The pressure by the GST department on the GST department is mainly target based and based on revenue collections. And keeping this in mind, the GST evasion, in my view, is actually going to increase rather than decrease. And the curbing through these rules would ideally then affect the bona fide assessees and the genuine taxpayers. The one of the most important changes which has been deliberated in the past 3 years is bringing of petroleum products under the GST regime. This can be done through by way of a notification. There is no requirement of a change in the GST Act, but this has not been brought into GST, probably because this plays into the hand of the state governments and even the central government in way of high amount of revenue, which cannot be done so in the GST regime. Natural gas, which is also an essential for all the manufacturing industries, is presently being taxed under VAT for 24.5%, which also can ideally be brought under the GST regime. So keeping all these things in mind, and the way the amendments have been brought into effect from this January 2022, it seems to be that the trust and the basis of giving the opportunity to be heard, the concept of natural justice, all this is being tried to be done away with, and it is going more towards something of a communist nation, which is very sad to say, but it seems to be that we are heading down that path. So we'll be discussing on certain changes. Some are sectoral specific and some are general changes. So denial of course, the unmatched credit, blocking of GSTR-1 filing, widening of the recovery provisions, provisional attachment, e-way bill restrictions, and other key changes, including the GST portal updates. Sector specific concept of mutuality, which has been brought in retrospectively. The e-commerce change, wherein the passenger transport and the restaurant services have been brought into the liability of the e-commerce and not the actual suppliers. Changes in the rate of tax for government projects and textile and footwear. I have also included some important judgments which have come up in the recent past, and also those which may be useful for some of the sectoral specific changes and the general changes which we will be discussing today. I'm not sure if I'll have time to go through the judgments, but I've included them in the PPT. As I understand, this PPT will be shared to all the participants. So coming to ITC, the story so far has been that from July 2017 to the October 2019, there was no restriction specifically there in the GST law where it required a matching with the GSTR-2A or 2B. In from 9th October 2019 till December 2021, this restriction was brought through Rule 36(4), wherein the restriction was kept up to 100% and allowing an ad hoc percentage, wherein it was reduced from 20% to 10% and then to 5%. From this January 2022 onwards, Section 16(2)(a), which was inserted through the Finance Act, has been made effective, and Rule 36(4) remains, which means that now the Rule 36(4) has an authority figure in the GST Act. So until December 2021, can we say that there was no parent act, therefore the Rule 36(4) is ultra vires? This is a question which has been brought in front of many high courts. There have been certain instances wherein they have allowed the credit based on its if it is genuine and whether all the other eligibility conditions have been satisfied. In this situation, whether from 1st January can a person claim credit if it is not there in GSTR-2B? That is the one simple and important question that we all must know, and the answer is no, they cannot take the credit from 1st January 22 onwards. But before that, I feel this issue could be litigated. Even we have seen many audit notices which have come for 2017-18 and 2018-19, where Rule 36(4) was not applicable, but there have been notices from the department where they have actually matched the ITC with the GSTR-2A and asked them to reverse the credit along with interest. So these kind of notices which do not have any basis of law have to simply be responded in a respectable manner, telling that there was no law which was available and can ask not to be paid. I will take the questions probably at the end of each topic so that we can clarify all the questions at one go. So Section 16(2)(a) has been introduced and included in as part of those eligibility conditions, wherein they have said specifically that the return under Section 37, that is the GSTR-1, should have been filed by the supplier, and such details should have been communicated to the recipient. This communication happens through form of Form 2B, GSTR-2B. If you all have seen in the recent past, they have also said that from January 22 onwards, the GSTR-2A is no more invalid and it will be removed from the GST portal also, which means that only GSTR-2B should be the basis of doing the reconciliation. The ad hoc credit of the 5% which was available up to December 21 will no more be there, which means that if the vendor has filed the details, then only the credit can be claimed. So just to give a slight brief on what is the difference between GSTR-2B and GSTR-2A. 2B is a static report, 2A is a dynamic report. And a simple example is if the vendor files his invoices and his GSTR-1 after the due date, the GSTR-2A will get updated for that month, but GSTR-2B will not get updated for that month. It will be updated in the next month. So if there is a delay in updating the data in the GSTR-1, it would not appear in the GSTR-2B for that month. It would appear in the month when he has actually filed the GSTR-1. You would get the IceGate, the bill of entry details also in GSTR-2B. And this actually gives you a very simple mechanism wherein you do not need to go back and do the reconciliation over and over again for the same month. So in that way, GSTR-2B is more helpful than GSTR-2A. But to the extent that in the brief period between say 13th or 14th of the month and 20th of the month, if any vendors are filing the credit for that month, in GSTR-2A, before filing the GSTR-3B, the credit would have been visible and ideally eligible. So if the vendor has filed even between this period, it would still not be eligible to be claimed by the assessee because of the fact that it will not appear in the GSTR-2B of that previous month. It would appear in the next month. So the moot point which comes out of this is, how can a customer or a recipient or our clients ensure the satisfaction of this GSTR-2B and ITC reconciliation and claim, and vis-a-vis not affect their cash flows. So the easiest way of doing this is by changing your payment terms. Payment terms can be changed, say, to a 75-25% ratio, wherein 75% will be paid upon completion of the job or any other business requirements, but 25% will be withheld and will be paid only after it has reflected in the GSTR-2B as filed, not as something which has only been uploaded. It has to be a filed return. So in this situation, what helps the customer or the recipient is that he has control of the credits he's claiming, and also to that extent he saves that cash flow which can be used for this for his own business. Another advanced level of ensuring the GSTR-2A and 2B matching is to create the vendor analysis and vendor categorization. So generally this is done wherein vendor A category will be the compliant category, wherein you do not need to include such types of payment terms, or where you may not have the ability to impose such payment terms. Say for example, you have a electricity bill, the internet bill from Airtel. In this situation, Airtel is the bigger entity, wherein you will not be able to force them to change the payment terms, wherein you say, I'll pay you only after it reflects in my GSTR-2B. So there will be certain entities who you will not be able to push the payment terms upon. So, and those entities who are completely compliant, those persons can be kept in category A. Category B can be those people who you trust and generally file on a compliant basis, but are not or at a larger size. So for these persons, it is up to you whether you would like to enforce this payment terms. But category C, when we come to, these are the persons who will not be in as part of an organized sector, maybe may not be filing returns regularly in the past, and their track record is not very great. So in these situations, it is always advised to implement such payment terms and ensure that this is communicated well before the goods or services have been supply has started. So coming to our clause 16(2)AA, it does not apply to import of services. It does not apply on the credit which is distributed through ISD, which is your GSTR-6, and it does not apply to the RCM related ITC. So basically it relates to only those which have been provided by a supplier, where the tax has been paid to the supplier, who is then required to pay the tax to the government. And in no other circumstances would this reconciliation be applicable. So one of the main activities which has not been addressed by the department is this unjust profiteering, which means that if at any point there has been a lapse in this ITC claim, say the credit has not been updated by the vendor in the GST portal, the department goes to both the supplier and the recipient and asks them to pay the tax in relation to the amount that has not been paid to the government. Now, in this scenario, there is one very difficult thing to address, which is that whether the department has the ability to approach both of them, whether a person can ever know that the government has actually approached both the recipient and the vendor. So these are things which may be difficult to follow, but these are things which have to be verified, and therefore if there is any payment which is being made in lieu of any notices which are being given by the department, always suggested to cross verify with your vendors. So scenario where the supplier has filed returns, paid the taxes, but after the due date is prescribed for availing the credit, how does this interplay with section 16.4 has not been addressed? Which means that if I have filed my returns, paid my taxes after 30th of September, now in this situation, whether there is a possibility to claim the credit. Now that has not been specifically addressed, but to be on the conservative side, it may be that the credit will not be eligible. So again, in these scenarios, these kind of persons who delay their filing of returns must be kept in category C. Once the time limit has been crossed, which is the September of the subsequent September of the financial year, such taxes should not be paid anymore to such parties and must be communicated to them with the clear information that the credit would not be eligible to the recipient. There's a small write-up on the concept of equality and how it affects the people. And therefore, there is a possibility that this section 16(2)AA, bringing it into GST, it may be very useful for persons who have the ability to track such credits through automatic means, through tools, or appoint certain professionals who will be able to take this up and help them with their credit claim. Now, in this concept of equality, would the same possibility be available to the small and medium enterprises? Would they be able to track this and ensure that the credit is being paid and has been received, paid to the government? These are things which cannot be done. And therefore, this case law, Supreme Court case law, may very well be useful if being disputed in the higher forums. So one of the other things which is as part of 16(2)C of the GST Act is that the recipient has to ensure that the vendor has paid the tax to the government. Now, where does the methodology allow in the GST portal for any recipient to verify that the vendor has paid the tax? Even in GSTR-3B, there is no invoice level breakup, which means that there is no information as to what credit has actually been claimed. Even now going forward, say in your GSTR-2B, there is 100 rupees of credit which is showing. In that, actually, the eligible credit is only 75. So you claim 75 and you go ahead. You will not be able to disclose to the government that these are the invoices against which this total comes up to 75 rupees of credit. And therefore, in what capacity can a recipient verify that the vendor has paid his tax, which there was paid to the vendor, to the government? Now, when this is an impossible activity, there are clear judgments where the recipient cannot be asked to do the same. So therefore, that 16(2)C until GSTR 1, 2, and 3 are brought into the picture cannot be enforced on the taxpayer. The department, of course, this is what I mentioned, that is they're proceeding against both the supplier and the buyer, and whether in the case that the ITC which has been reversed is being paid by the supplier, whether then this will be refunded back by them on a suo motu basis without any application. I highly doubt this happening, but this is something that is the right of the person, and therefore this is the reason every time there is any notice with respect to this GSTR-2A mismatch, and if the taxpayer has agreed to pay some liability, ensure you cross verify with your vendors against those transactions whether they have also been asked to pay, and if yes, then if they have paid anything, the payment need not be made again against such credit. Some grounds for disputing again these conditions also which have been brought in on the grounds of being harsh, oppressive, unreasonable, or arbitrary can be covered under Article 14, that is your right to do business, and Article 19(1)(g, linked to your equality. So coming to ITC matching, with whether it's legally valid, there have been cases, of course, in the GST law. But coming to one case which is there and which was there under the VAT regime, where it was categorically held that default of the supplier cannot be the grounds to deny the ITC. This is what I was linking with the payment to the government, and this also can be linked to him uploading in the GSTR-1. So if you have satisfied all the other conditions and the credit is substantial, there is always a possibility of disputing such credit. There is also one section 38 where it says that a person who is available is having such eligible credits, but the vendor has not uploaded the details in the portal, has the ability to declare it himself and ensure that the credit is claimed. Now, even though the section 38 is linked again to the GSTR 1, 2, and 3, which was deferred from the start of the inception of the GST law, this can be something that can be used in the court as a defense, where we can ask them that the credit is eligible and I do not have the ability in the GST portal to upload these credits to the vendor and claim my right. So we will see some of the practical issues which are being faced. The first one is in relation to ITC, which is reflecting in the GSTR-2B but not in the books of accounts. So some of the reasons why this reflection is there can be noticed. First is the airline bills, the clearance, forwarding, handling bills which are there from your transporters, customs authorities, bank charges from banks, even internet and telephone communication expenses. Here what happens is there's a very common issue where the taxpayer does not have the tax invoice, and therefore this leads to a denial of credit. So how they get this information through some other channels, or it will be there in their emails, or it will be there as part of the bank statement. So there is no tax invoice which is provided directly by the airline or the transport agencies or the bank. So in these situations, it's specifically required that the invoice is asked for and documented. Sometimes a common error is that the GSTN is not provided. We will come to that later. Coming to the matching, generally manual matching is being undertaken. There are of course tools available on the in various platforms which can be used to match these credits. The main thing which has to be understood here is that these tools use one additional activity which is called the fuzzy VLOOKUP. Now this is not the common VLOOKUP which we all know, where it just picks up the data from the table, but this gives you approximate match. So this approximate match gives you a lot of help in identifying those credits which are similar to what actually it should have been, and therefore then you can identify manually and claim these credits, and therefore these tools are very useful. To ensure that the credits are not where they're not reflecting in the books, the internal systems must be strengthened. The accounting must be done at a reasonable point in time on a periodic basis, and wherever there are employee reimbursements, to ensure that they are giving the GSTNs and that has been accounted in a manner that the credit has been claimed. So generally what happens is, where they assume that the credit is not eligible, the taxpayer accounts it as the expense account debit to bank, and that's it. There is no accounting of the credit separately. So in this situation, even if say an auditor wants to come and verify the books of accounts, what happens is they will not even be able to verify such invoices, because it does not reflect in their list. So always maintain a separate expense account, where if you in your belief it is ineligible credit, maintain expense account debit, ineligible ITC account debit, and to bank. What happens is then the person can go through the ineligible account separately and then identify if there is any eligible credits or the reasons why it has been passed in the ineligible column. So which means that there should not be any credit which has been accounted under any other head. It should either be eligible or ineligible. So review and sanitization of the data from the books which are being uploaded, completeness and correctness, this helps in matching the data which is there in the books against GSTR-2B. And of course, the data which has been there for previous years or subsequent years, these spillover transactions always have an effect, which means that an entry which is there in the books of accounts would have reflected in the GSTR-2B of last year. or it is there in the books of accounts presently, but the vendor has filed at a later point in time, and therefore it is reflecting in the subsequent year. Now, this also has a link to that September time limit. So therefore, please keep this point in mind, where spillover transactions to the extent of September have to be reseen, and to the extent they can claim the credit has to be claimed, and to the extent the credit cannot be claimed has to be passed as an expense in the books of accounts or to the vendor's account. One of the common issues which have been seen is that vendors are uploading the credit notes in their GSTR1, but the same credit has not been reversed by the recipient in their ITC and their GSTR-3B. This will lead to a notice and a claim from the department in the future, and therefore be clear with the vendor as to when they are raising a credit note, whether it is with or without tax, and where it is with tax, to ensure that that credit is being reversed without fail. Now we will see some of the issues which are where ITC is reflecting in the books of accounts but not reflecting in the GSTR-2B. One of the major issues, of course, is that the GST-IN of the taxpayer has not been provided, or an incorrect GST-IN has been provided. Another common thing is that the transaction has been considered as a B2C by the supplier, even though the details have been provided. And certain larger entities will not agree to change it from B2C to B2B once the invoice has been raised and the GSTR1 has been filed. So debiting tax cost to the supplier, this is of course a possible option, but it does lead to some undue profiteering for the government, wherein he will still may have to pay for the tax for which this against the supply which he has made. Keeping ITC in the wait list for review in the GSTR-2B of the subsequent months. So this is a very important process, wherein wherever GSTR-2B credits are eligible but have not been claimed, have to be kept separately in an Excel, and keep it there to ensure that the invoice then are received subsequently. Similarly, the other way around, where you have the invoices but it's not reflecting in GSTR-2B, keep that list also separately on a continuous basis, so that for the year, including the plus 6 months which is there up to September, these details are tracked and captured on a consistent basis. Challenging the law on the grounds of section 16(2)(a) or rule 36(4), keeping in mind those time periods, which is up to October 2019 up to December 2021, and then going forward, there is a possibility to constitutionally challenge these laws. So availing the ITC without utilizing the same and keeping it as a buffer in the electronic credit system. Now here there's an issue where your system will not allow you to store your IGST balances, even though the concept and the process of availing and not utilizing is sound, keeping in mind the net liability concept of interest. This issue is being practically overcome due to the IGST credit utilization, wherein first the IGST credit must be utilized completely before you utilize the other credits. And therefore, there is no option to maintain an IGST balance wherein you are not clear about the credits. So here there is, of course, one other option, which again is disputable. Let me say this is my personal view, is that wherever there are ineligible credits which in your view are eligible, or you are awaiting a judgment, say for example the Safari Retreats case wherein the credit can be claimed against the immovable property, in these situations the credit can be claimed and then reversed under protest, and this under protest can be by way of a registered post letter to your jurisdictional officer, giving all the details and the reason why it has been reversed under protest, and that in the event that the Supreme Court gives a favorable decision, this credit will be reclaimed. Now, this is a process which was followed in the erstwhile regime. There is no specific entry under the GST law for duty under protest, but this can be said to be one of the process of natural justice, and can be followed. Recently also in a circular, they had given this concept of under protest, even though it is not there in the GST law. And I feel it is a valid option which can be considered. So some of the other issues which we can address, which are there, are invoices which are dated prior to 1st Jan, but the ITC is availed in Jan 2022 or later. Whether I would have to follow this concept of claiming the credit only based on GSTR-2B. In my view, the answer is yes, you will have to follow 2B. Reavailment of earlier reversed ITC post amendment. This should not have any impact with reference to the present law, which is 16(2)AA, because the credit is now, which is being reavailed, is not on the requirement of the update of GSTR by the vendor. It may be on account of the 80-day clause of the test type of credit. Treatment for the additional buffer of 5% which was claimed in the erstwhile period, which is up to December 2021. For the entire period, have been claiming 5% additional credit based on the invoices which are available. In these situations, you will have to, those credits need not be reversed, but please keep track and ensure that the vendors have filed the GSTR1 in reference to those ad hoc credits. This will reduce your chances of notice. Got a message that my voice is not clear. Is this the issue for everyone?
Yes,
Hello,
it is.
am I
It is
audible?
there is some break.
Okay, I'll just stop my video then, sir. Is that
Yeah, I
fine?
think maybe some network issue probably.
Fine. Is my voice better now?
Yeah, now it is better. Please move ahead.
Fine, thank you. So ITC, which is not available, where the tab which has been provided in the GSTR-2B, providing the details of such credits which are not eligible. One of the things where they are not providing, where the place of supply is a different state, wherein, for example, say you go stay in a hotel in another state and you are registered in Karnataka, and you get a Maharashtra bill wherein he will charge the CGST, SGST of Maharashtra based on the place of supply. In that situation, the credit will not reflect as eligible credit in GSTR-2B. It will automatically be shifted to the sheet called ineligible credit. One of the issues which I see which is coming out of this is the credit in relation to transport of goods outside India. So if I am a service entity who is within India, and you are a customer who is also within India, and you have asked me to send the goods to China or USA, I have to charge you IGST because the place of supply requires it as such. But in the place of supply, the destination of goods, which is USA or China, is the place of supply, and therefore if I need to change that in my GSTR1, I need to disclose in place of supply as 97 other territory. I will not be able to disclose 29 Karnataka, which is the recipient's location. This can also be part of the ineligible ITC. So in these situations, this creates an issue for the transportation of goods. And of course, this ideally has to be reached out to the GST Council to remedy this issue. They were actually in the intention to consider these services as an export of service, but because both the supplier and the recipient are within India, they are unable to due to the export of service definition. So in the situation that the supplier and recipient are having this credit issue, what is practically happening presently is that the dominant party is always winning. So the bigger entity is always in the driver's seat, who can decide whether he will pay or not, whether he can recover the amount or not, and the interest and penalty which is being levied is also can be taken back as a recovery mechanism. Working capital blockage for the suppliers is being there due to recipients ensuring this say the 75-25% concept. Availability of this ITC in case of minor mismatches wherein invoice number, date or amount is there. These are being used as tools to avoid payment and extend the time period to make the payment to the suppliers. So these are practical issues which we have seen in the last 2 to 3 years, and the requirement to file an appropriate, correct, accurate GSTR1 has never been more important than from January 2022. We will see that in the upcoming slides also, but the ability to now make mistakes has been done away with, which means the department expects us to be perfect, but I do not think the same is being applied to themselves. So some of the legitimate reasons why there could be a difference between GSTR-2B and the ITC as per GSTR-3B. One of the things is the goods in transit, where you have not yet received the goods, and therefore as per section 16 you are not able to account it. It's not an eligible credit, and therefore you do not account that credit also in your books of accounts, but it is already reflected in the GSTR-2B. Wrong invoice in the GSTR-2B in case of amounts or particulars, this also leads to a difference. ITC on the purchases, wherein instead of cancelling the invoice, the vendor has raised the credit note. So in these situations, again, these could lead to even more issues, because where the goods are not received at all and the invoice was raised, the credit note, if it is being raised, this could lead to some more issues. The fact that the goods have not moved, there may not have been an e-way bill, and that could again lead to certain questions being raised by the department. So if it is being cancelled within the same month before the GSTR1 is filed, then please ensure the invoice is cancelled rather than cancelled through a credit note. Of course, if it is beyond that, credit note can be used. So goods which are returned on the DC and ITC is reversed in month 1, vendor raises the credit in month 2. This is a common issue which is being faced in the trade industry, where the credit note is not being raised by the vendors. And to avoid this situation, one of the common methodologies being used is they are raising the invoice instead, rather than awaiting for the credit note. This again, in my view, can be disputed, but on a practical basis, this is a easier method to ensure that the taxes are clear and there is no waiting around for the vendor to be compliant with the law, and communication also reduces. Incorrect place of supply, of course, will lead to the ineligible credit increasing in the GSTR-2B. Courier imports will not auto-populate in the GSTR-2B under the ICE gate details, because it does not flow through the ICE gate portal. Reverse charge payable. In these situations, the auto-populated details from the GSTR1 is only an indication that yes, these are the entries where the recipient needs to pay the tax. This is not the entry through which the credit is eligible for the recipient. The credit is eligible based on the invoice or the self invoice which has been raised by the recipient. So some other credits which are there in the GSTR-2B, that is your import or service related reverse charge, would of course not be reflecting in your GSTR-2B. Even the ISD has the same concept. So this one, on a lighter note, how actually the GST Council and the department is looking at trying to catch the bogus taxpayers, but eventually the genuine taxpayers are bearing the brunt. It takes me to the end of my first section, which is on the credit. So I'll just go through some of the questions and then we can move on to the blocking of GSTR1. So there's a question that what about ITC paid on RCM? So again, ITC on RCM would not come for the reconciliation between GSTR-2B, because of the fact that the credit is eligible based on the invoice or the self invoice itself and not the GSTR-2A. One more question is, in few cases GST paid on imports are not reflecting in the GSTR-2B timely. How should this be addressed? again, there is no requirement under this 16(2) AA that the credit is eligible only if it reflects in case of imports. That is there only for invoices and debit notes. Imports as such are the credit is claimed based on the bill of entry. So if you link this to Rule 36(2) of the CGST rules, there you see the list of documents against which the credit can be claimed. There is where you identify that bill of entry is not considered as an invoice or a debit note. This is also the reason why there is a view in the professional community that the credit in relation to import of goods does not have any time limit, because section 16(4) categorically includes the words invoices and debit note but not bill of entry. So that is one of the issues. And of course, another issue which comes out of that is the TR6 challan, which generally is required during the debonding process, wherein it has to, the GST is paid through TR6 challan. But like in the SENVAT regime, it has not, in the SENVAT regime, it was notified as one of the customs documents, but not in the GST regime. Another question is, just wanted to know practical stand on GSTR-2B should be followed while filing 3B return for the month of December 2021 or January 2022 onwards. In my view, sir, this is applicable from January 2022 onwards. But if you are on a conservative basis and do not want to take any risks, suggest you to follow from December month itself. So when this question is being asked, the credit for the month of December is what is being questioned. In my view, it should be the credit for the month of January, and therefore the GSTR-2B, which comes from 13th or 14th of February, will be the date which has to be considered. So goods in transit as on 31/3/2022. Whether the supplier would have shown as sales in his book and reflected in GSTR-2B, how to account and avail the credit in case of the purchaser. So yes, this is a very common issue which is there. The credit is eligible based on receipt of the goods, which is actual receipt of the goods. And in this situation, the purchaser will account and claim the credit only in April 2022 and not in March. So for the purchaser, this is a credit of the financial year 22-23 and not 21-22. So in these situations, matching of this credit will be on the basis that it reflected already in the previous month, and therefore while you're claiming the credit in the month of April, it can directly be in your working, it should be said that this reflected in the month of March. So just to give a monetary example, say your credit in GSTR-2B in the month of March was 120, where this 20 was in relation to this goods in transit, and in the month of March you had 70, and in this month, in the month of March, ideally assume that all the credit was eligible. 100 was what you would have claimed in the month of March in GSTR-3B. That 20 would not have been claimed and would have been kept on hold until when the goods and the invoice arrive. And once that has been done in the month of April, you will claim 90 rupees credit in the month of April. On a net basis, your 2B and GSTR-3B should match. That is the requirement, and ensure you have the reconciliations for the same. So I believe we have answered all the questions. Shall I move on to the later part of my PPT? One more question is there. Will that not lead to prior period expenses under income tax if we account the purchases in April? So this issue could arise, but the fact is prior period is based on omission or commission. In this situation, it is neither. You did not have the tools or the documents to account it in the month of March. So assuming that you would account your details or your expenses as on date, and you do not have the ability to backdate any entry, In this situation, if I again ask you the same question for goods in transit, how will you account the expenses? It cannot be done on a backdated basis. And therefore, in my view, it is not a prior period expense. That concept would not apply here. So I'll move on to the next part, which is the blocking of GSTR-1. Again, this has been done to supplement the previous issue that we spoke on the ITC blocking, where the GSTR-1 is being filed by vendors without filing the GSTR-3B, which means they are enabling credit without actually paying the taxes to the government. So this has been noticed, and therefore to curb this issue which has arisen from bringing in this rule 36 for matching, they have brought in this additional feature where if the GSTR sorry wherein a registered person will not be allowed to file his GSTR-1 if he has not furnished the last month's GSTR-3B. So how this works is, assume for a month you have filed GSTR-1, you do not have the cash to pay the taxes through GSTR-3B, so you have kept it on hold. But next month again you need to file your GSTR-1 so that your customers can take their credit, which will further enable you to collect from the customers. This will now no more be allowed, because they are saying that you need to file the GSTR-3B of the preceding month to ensure you file the next month's GSTR-1. Another important change which is linked to this GSTR-3B and GSTR-1 is the amendment which has happened in the demand and recovery provisions. Earlier, the under section 7512, the direct recovery of self-assessed was allowed only if it was unpaid, which means there was actually no option, because self-assessed was coming through GSTR-3B, and if there was no option really to file the GSTR-3B without paying the taxes. So this had to happen through the process where they had to go through the demand and recovery process under section 73 and 74, which takes a longer time. Now the amendment which has been made is that the details which are disclosed in GSTR-1 also are said to be self-assessed and liable for direct recovery, which means that if I have uploaded any details in my GSTR-1, not filed my GSTR-3B, they do not go through the normal recovery proceedings. They can directly recover from me the amount. So this is a very clear indication where they are specifically directing the taxpayers that when you file your GSTR-1, ensure your GSTR-3B matches it. In the event you file a GSTR-1 which is higher than the GSTR-3B, for whichever logical reason it is, the department now has the upper hand wherein they can first initiate the proceeding, take the money from you, then you have to go in appeal against whatever amount they have recovered. So this of course will directly affect your clients or your own businesses, and therefore the takeaway from the change is match GSTR-1 to GSTR-3B. If there's any entry that you have not updated in GSTR-1, update it in the next month. You may have to pay interest on that, but that will ensure that there is no issues with the department or recovery, where they may sometimes even attach your ITC or your bank account, which can also lead to even more difficulties. One of the fallouts of this change, this amendment, is that the clerical mistakes which can be made, which is pretty common when there is manual filling, which means the smaller and medium enterprises again are affected by this, wherein the clerical errors and unknown omissions can lead to some direct recoveries. So the concept of this self-assessed tax, where they have included, they've extended it even to GSTR-1. This entire concept of collecting on this self-assessed tax and not giving the natural justice from the first point of recovery is violative of the Article 19, which is your link to business, and Article 301 and 304 of the Constitution of India. Taxes may and do amount to restrictions, but it is only such taxes as directed and immediately restrict trade that would fall within the purview of Article 301. So in this case law, This is given specifically to suggest that this Article 301 will be affected only when it actually restricts trade. Otherwise, whereas such taxes is not restricting trade, such measures cannot be said to be valid. If you see Rule 86A, where they have the blocking of the credit ledger, asking of this 1% from on the cash ledger of the cash component, these are all restrictions which are already under challenge, which are under the same concept. So any questions with regard to this GSTR 1 and 3B change?
There are no questions as of now.
Fine, sir. I'll move ahead.
Please, yeah.
So the provisional attachment scope has been widened. This is, of course, to ensure again the curb on those persons who are doing the bogus transactions, the fake invoicing or fake credit. So section 83, which provides for the provisional attachment of the taxpayer's property during the pendency of any assessment under 62, 63, 67 or demand and recovery procedures under 73 or 74. There are enough high court decisions which say that the proceedings are until then which they are completed, this provisional attachment can be done, but once they are completed, this provisional attachment shall be removed. And where there are no further proceedings, there cannot be any provisional attachment. Now the proposed amendment in lieu of this is that after the initiation of any proceedings under these chapters, the commissioner is where the commissioner is the opinion that the purpose of protecting the interest of the government revenue, it is necessary to do so. He may by in writing attach provisionally any property including bank account belonging to taxable person or any person specified under subsection 1A of section 122 in the manner as may be prescribed. So impact which arises is that the initiation is enough to make the attachment, which means it need not reach any specific level, and just the initiation can lead to a provisional attachment, which means again there's a lot of power being given in the hands of the GST officers. Property of the intermediary or those in the chain of the transaction in case of fraud and serious evasion cases can also be attached now. So this is what is covered under that section 122 1A. So say I am a trader and I am part of a chain wherein this fake invoicing or bogus invoicing is happening and the credits are being claimed without an invoice. If I am part of that chain, even though the invoice is not to me, my property can be provisionally attached, saying that I am part of this entire chain. So this is very, very difficult to identify. There can be a situation where you are a genuine taxpayer, you are doing the transaction appropriately, but there is a in the chain there is some person who is doing some bogus transactions. So be very clear. The requirement to maintain documentation for all your transactions, and not just the tax invoices, the proof that the reason why the tax invoice even came into picture, that is your PO, your SO, your work order, these are useful documentations in the event that your bank account or your credit ledger is provisionally attached. So no credit, cash, a cash credit or OD account can be attached. The summons, returns, scrutiny, arrest cases, etc. also can be now covered under these headings because it's now under chapter and not section wise. So the cases where this provisional attachment can be resorted to by the department: supply of goods or services without invoice, issuing invoices without the supply of goods or services, fraudulently availing ITC without supply of goods or services, tax collected and not paid for more than 3 months, fraudulently obtained the refund, passed on ITC fraudulently to the recipient, but has not paid the tax to the government. Means GSTR 1 is filed, but not the 3B. So this guidelines has been provided in the CBSE document. I tried to go through the GST CBIC circular page, but I was not able to find it. But if you put this specific citation, which has been given in the PPT in the Google, you will be able to obtain it. So order of attachment has to be communicated by the commissioner to the concerned revenue authority via GSTR form DRC 22, along with the copy to the person who is actually concerned with this. Objection can be made via form GSTR DRC 22A. Time limit of 7 days from the attachment has been done away with, which means there is no specific time limit, but once there is an attachment, suggested to respond through GSTR 22A. Now, the rationale which is given behind our Supreme Court decision in case of Radhakrishnan Industries and the Gujarat High Court in case of Valerius Industries is very important, from the fact that if in the event that there has been an incorrect provisional attachment wherein the officer has gone beyond his powers, where he is not assessed the scenario properly and has provisionally attached a genuine taxpayer's property, some of the these case laws which indicate how and why these provisional attachments can be used have been given here. These powers which are there are very drastic and are far reaching. They must be exercised with extreme care and caution and must not be used to harass the taxpayers. It is only to be used as a last resort when there is no regular means of recovery. It should be done based on credible material and supervening factor and not casual evidence. This is very important because this is where generally they will slip up and they will not have certain credible reasons why they are attaching the property. Joint Commissioner, while ordering a provisional attachment, was acting as a delegate to the Commissioner in pursuance of the delegation which is effected under Section 5. And an appeal against the order of this provisional attachment was not available under Section 107. Writ petition before the High Court under 226 of Constitution challenging the order of provisional attachment was maintainable, which means this is also possible. The expression which is given in the amendment necessary to do so for protecting the government revenue, this actually implicates that the interest of the government revenue can never be protected without ordering a provisional attachment, which is absurd. This cannot be a view that can be taken, and therefore this expression ideally should not have been brought in through the amendment. The persons whose property is entitled to dual procedural safeguards, which are first is that when the provisional attachment has taken place, the opportunity of being heard must be provided. The opportunity to submit objections on the ground that the property was or is not liable to attachment also can be provided, and the commissioner is bound to deal with these objections by passing a reasoned order which must be communicated to the taxable person. If the appeal is filed against this order under the demand and recovery provisions, the provisional attachment shall cease. This is also very important. No second time attachment can be done without there being any change in the facts and circumstances of the case. So that brings me to the end of the next area. I do not see any questions. I'll move on. So this is the changes which are there with regard to the movement of goods, which is your detention, seizure and confiscation. Here also, I think we all have seen a very common issue where there is some form of harassment in the e-way bill, or there is a situation where compliance is expected, but it is not as a high level as that is the standard which is can be expected. There are errors in raising the e-way bills. There are certain situations where e-way bill is not raised at all because of the fact that they didn't know that it was supposed to be raised for those types of transactions. So these are things where the previous regime and the new GST regime has brought into some new laws, which the training for the common man was not clearly available, and probably even the training for the GST departmental officers who may be following the old law. So the change in regard to the penalty has been increased substantially. If you see with regard to exempted goods, there is no issue because it remains the same. Only when the taxpayer does not volunteer. No, sorry. There also it is the same. The only in case of the taxable goods where he has volunteered to pay the tax or he has not volunteered to pay the tax, in both the cases the penalty has been substantially increased. So if it is he has volunteered to pay the tax, even still there will be a 200% of tax which will be penalty, which means of course that is not an eligible amount. 50% of value of goods or 200% of penalty, whichever is higher. So if you are carrying very valuable goods, this implication of ensuring the e-way bill becomes even more so important. Failure to pay leads to confiscation of goods or conveyance can be detained. That was the previous law. Now they have the ability to even sell the goods or the conveyance which has been detained. If the transporter pays the penalty of 1 lakh, the penalty or 1 lakh, whichever is lesser, conveyance only would be released. So because generally there will be 2 or 3 persons in the transactions and transporter will be separate, they have given an option for him to release his own conveyance only and not the goods. So time limits now have been brought under the CGST Act. Now confiscations can be made only if the ingredients of section 130 are present and cannot be undertaken for the detention and seizure of goods or conveyance under 129. They have specifically delinked the section 129 and section 130 and made them mutually exclusive. This can also be seen in the High Court judgment of Synergy Ferticare Private Limited, Gujarat High Court decision. Section 74 is proposed to be amended to make the co-notice proceedings under 129 and 130, and these co-notice proceedings will continue even if the demand recovery proceedings are completed on the other persons. So which means that they can go for multiple proceedings for the same issue. Pre-deposit of 25% is prescribed now to file an appeal against the penalty order in case of goods which are seized or detained. So these are the changes with respect to detention, seizure, and confiscation. Now coming to the procedure for recovery of penalty by sale of goods or conveyance detained or seized in transit. This has been given through Rule 144A. So there is a procedure where there is an e-auction which will be conducted to sell these goods. And if that penalty has not been paid within 15 days from the receipt of the order, in case of perishable hazardous goods, that date can be reduced by the officer. The process is through a e-auction, and that notice will be issued through DRC 10. In case of the appeal which has been filed against order 129.3, which has been received, the disposal of the goods or conveyance shall be deemed to be stayed other than for the hazardous goods. I mean perishable or hazardous goods. The appeal must be filed within 15 days. This is very, very important because of the fact that if you delay beyond 15 days, then you have the ability to lose the goods itself, and that goes through the auction procedure. So I saw one question, I'll just take that. I think there's a question on yeah, that recent amendment that whatever is present in GSTR-2B has to be considered input. Even earlier that is not made by the client. Please clarify what comment has to be made in 99C in respect of financial year 2021 or earlier years. So Mr. Manohara, the issue here is that you again need to see it on the time basis. So before October 2019, you can say there was no requirement to match. From October 19 to December 2021, you can take the view that it need not be required on the basis that Rule 36.4 was ultra vires the GST Act, but that is an aggressive view. In the that these clients' risk appetite is very important when we discuss these kind of issues. For 2021, there is no requirement to make audit because the compulsory mandatory GST audit by a CA or a CMA is not required, and therefore Part B of 99C is no more there from 2021 onwards. For the previous years, maybe you will need to see the client's risk appetite and comment accordingly. The words written that whatever is there in the 2B has to be considered as input is very incorrect, because of the fact that there may be ineligible credits which are not even for this GSTN. So reading section 16 in line with this GSTR-2B 3B reconciliation is very much required. There are also restricted credits under section 17 which may appear in 2B that must not be claimed. So please note these errors will not be pardonable, and of course you may receive a notice for the interest also on excess credit claim. If it is not utilized, again there can be a dispute on the net liability basis. So Naveen has asked, could you please explain the penalty for tax payable again goods, 200% of tax payable as per new provision? Does this mean tax plus 200% of tax payable as penalty? Yes, this is what it means. Tax plus 200% of tax payable as penalty. Said that my voice is breaking again. Am I audible?
You are audible now. Please continue.
Fine, sir. So the mandatory Aadhaar authentication now has been brought in for two very important activities. One is the filing of refund application. So those entities who are SEZ units or having high volume of exports or under the inverted duty scheme, filing these refunds will require to have an Aadhaar authentication. There is a possibility that a person has paid excess taxes and wants to take a refund of it. Even for that refund application, Aadhaar authentication is mandatory. So therefore, this is a procedure which can be done for all the registrations to avoid any future issues. Application for revocation of cancelled registration also requires the Aadhaar authentication. In the event these documents are not Aadhaar authentication not possible, then the same authentication can be done through separate methods: voter ID, passport, bank passbook, DL. Aadhaar authentication with an Aadhaar number should be undergone within 30 days from the date of allotment of the Aadhaar number. So which means this has to be done immediately. Please do not delay this activity. Aadhaar authentication can be done on the dashboard in the My Profile tab, Aadhaar authentication status. Persons who are exempt from filing this, person who is not a citizen of India, department, CG or SG, local authority, statutory body, PSU, or a person who is applying for specific registration such as specialized agency like UNO, multilateral financial institution, these consulate or embassy or foreign countries, these people are not required to do this other mandatory other authentication. So extension in filing form GSTR 99C up to February 28, 2022. It was earlier 31st December. There may not be an extension considering the COVID wave. There may be an extension, but ideally the way the government is behaving, I doubt that they will give an extension even for 1 month. Periodicity in the intimation of job work details in form ITC 04. This is to disclose the data of the goods which have been sent to the job worker and received back. In that situation, they have eased the compliance wherein those persons who have a turnover more than 5 crores, they need to file on a half-yearly basis. Earlier it was quarterly. and below 5 crores, it was quarterly. Now it has been made once in a financial year, effective from October 1st, 2021. Time limit of 2 years has been prescribed for filing the refund in claims in case where incorrect type of tax has been paid. So say you have paid CGST, SGST instead of IGST, then and you're going for a refund, then you can, the time limit would be 2 years. If you are specifically covered under section 77 or 19, section 77 of CGST Act and 19 of IGST Act, where inadvertently you have paid, which means that you assumed a transaction to be CGST, SGST, you charge CGST, SGST, collected and paid CGST, SGST. In this situation, if that transaction was later on identified as an IGST transaction, if the department holds it to be IGST, then they need to pass an order asking you to pay IGST, and in that order they should be allowing you for a refund of CGST, SGST, and there would not be an interest. In any other scenario where you have inadvertently just disclosed in GSTR1 and paid incorrectly in 3B, those will not be covered under section 77 or section 19. Be very careful when you are identifying these transactions, and wherever incorrect taxes have been paid and are payable, the correct taxes are payable, do so immediately to avoid the issues of interest. The term for anti-profiteering authority has been extended for 1 more year. So refunds claimed by foreign diplomats in ROD 10, this they have to authorize in the event that the UIN of the applicant is not available. The section 151 is where the commissioner is granted power to issue a notification to collect statistics in relation to GST. 150 and 151 now can be used for any proceedings under law, but only after giving an opportunity to be heard. So this is where the information which is collected by the commissioner has to first be provided back to the assessee. Then, of course, the notice should be raised. So in this event that they do raise the notice, they should at least ensure that the details are provided and that opportunity of being heard is given to the taxpayer. This is coming through this section 152. Some GST portal updates which are there. Implementation of restriction to file GSTR1 if the 3B of previous month is not filed. This is being done in the portal also to restrict the taxpayers. Module wise functionalities are available in the GST portal, which can be very useful to update and understand. Advisory on the revamped HSN code. The functionality has now been made available in the GST portal itself. Earlier, it was actually there through the CBIC portal. Now available in the GST portal in the user services tab in the search HSN code. GSTR1 amendment for FY 2021 is not allowed on the portal in line with the law. As you know, earlier actually in 2020-21, if I was even beyond September, if I wanted to make some change for 2019-20 GSTR1 invoices, I was able to do so and ensure that the invoice was corrected for the customer. Now that is not allowed in the portal because of the time limit which is there in section 37. Upcoming feature is the automatic interest calculator for delayed filing of the GSTR-3B return. Of course, that liability will be calculated, interest will be calculated on the net liability basis. So any questions with regard to these amendments? With this, we have completed the general amendments and we'll be moving into the specific.
Akshay, there are two
activities
questions
or
you must have answered,
yes,
no?
Which one, sir?
In Q&A, there are two questions, no? You answered those?
I have answered these.
You answered.
Those were relating to the first issue.
Yeah. Okay, fine. No other questions.
Yeah. So the concept of mutuality between the taxability of associations and clubs has now been reignited with the change in section 7 through 7AA, wherein the activity or transactions by a person other than an individual to its members or constituents or vice versa for cash, deferred payments or other valuable consideration is considered as a supply under GST. The explanation is what is very useful here, is that the person and its members or constituents shall be deemed to be two separate persons, and the supply of activities or transactions inter se shall be deemed to take place from one such person to another. This is bringing in the liability. This has been introduced with a retrospective levy from 1/7/2017, and the schedule 2 entry also has been omitted. One of the biggest issues why this is incorrect in the eyes of many professionals and the Supreme Court actually was that one cannot do business with oneself. Associations are the same as members. This was given in the Calcutta Club Apex decision, where the service tax levy was struck down. So because of this, ideally, the wordings in the CGST Act itself were changed to ensure that the tax liability has been brought in. So what is the impact? Now the impact in this reaches far beyond associations and clubs. Now any transaction between for a person who is considered as a single person in a logical term, but in the legal term may be considered as two persons, can be said to be liable to GST. Those who have stopped paying GST on these clubs, associations may have to restart. For those resident welfare associations where they're charging less than 7,500 per member, again re-examine the transactions keeping this in mind, because there may be some other transactions which may have been charged, which also may not have been subjected to levy. Those who are paying more than 7,500, say the monthly charge was 12,000, then on that 4,500 rupees additional, the GST should have been paid. They can continue doing so. Entire amount is not liable to GST. Interest applicable for the past. So for the past, because it's a retrospective implication, if it is being paid, the interest need not be paid based on the fact of this Supreme Court case law, because it's a retrospective insertion of the levy. A very huge ambiguity which is there is the credit which is there in the past. Now, keeping in mind the GSTR-2B and the other limitations which are there, the credit for the past periods, how can it be claimed? How can it be set off against my tax payable is going to be a very big issue. So in my view, this again will be challenged constitutionally on the basis of mutuality. But in the view to avoid departmental notices and probably attachment and all the recovery proceedings, paying under protest may be an better option. Coming to passenger transport, we have passenger transport through e-commerce. Earlier, the taxis, the radio taxis were already considered under the section 9(5), where instead of the actual supplier, the e-commerce is made liable to collect and pay the tax. Please note, when they say collect and pay the tax, they also use the words that all the provisions of law would apply to such persons in the same manner it would apply for the original supplier. So in this situation, the taxpayer the supplier will not have any issues, but the e-commerce is liable to collect and pay, and the law applies only to the extent of his collecting and payment of tax and does not apply entirely to the e-commerce. This is one of the views that can be considered to avoid the ITC implications which may arise for the e-commerce operators. So the change now actually which has come into picture from 1st January is that the supply of transport of passengers through omnibus or any other motor vehicle through e-commerce operator has been included. They have also given the definitions of the various vehicles under the Motor Vehicles Act and linked it to these provisions. So the impact now is that auto rickshaws, non-AC cabs will become more costly where they are supplied through the e-commerce operator. So the difference is that if I was going to take an auto on the road, if I hail an auto on the road and he's charging me 100 rupees, the same auto for the same distance, if it is hailed through the e-commerce operator, will cost 5% more. Of course, other charges I'm not considering, but that is the implication. So based on this fact that when the same activity, which is not something which is of a luxury or a sin goods, sin services, in this situation, how can you tax the same activity differently when it is being done at the same level? So this has been challenged. I think Uber and I think one more entity challenged on the basis of Article 14 and 19(1)(g), and the verdict is awaited. So if the reasonable grounds for why there is a different type of taxation between the normal vendor on the supplier on the road or the e-commerce operator, then only the taxation will be upheld. If not, it can maybe liable to be reversed. Of course, there are differences between services provided by a person if you hail an auto on the road and through an e-commerce operator. Just one how the impact is in reality. If you see, the cab is now cheaper than the auto. Basically what is happening is e-commerce ability to do business through the auto services in their e-commerce website has been done away with through this notification. So no taxation can restrict business, and that may be the grounds on which they are going ahead with the challenging in the High Court. There was one question. When the faceless assessments and appeals under GST will come into force, with the fact that they have removed the GST audit to be done by the external auditors, the concept of bringing faceless assessment appeals may be very tough. The fact is that the department then will have to have that much of data analytics to ensure that they are verifying all the issues. Ideally, only this ITC is being provided on an invoice level. I think that is one of the major challenges for the GST government to ensure that the credit is being on invoice level. So then maybe they can verify and do their data analytics on a back end. But still, I feel the far way off. Under which section or rule paying under protest is allowed? Like I said, sir, there is no section or rule in GST. This is a concept of considering the principle of natural justice. Restaurant services provided through e-commerce. This also now from January 22 has been brought into the section 9(5), where e-commerce is liable to collect and pay the taxes. Where the restaurants were already registered under GST, it is just a switch from the restaurant to the e-commerce, and therefore there would not be any impact. But where the restaurants were unregistered, the GST was not being paid because restaurants were not charging the tax. Now this change has resulted in a huge gain for the government. Even the uh, e-commerce with reference to the non-AC cabs and the auto rickshaws, there also the tax was not being paid by the suppliers because there were exemptions or they were below the threshold limit. And therefore, due to these changes in the law, where the e-commerce is being made to pay the tax, they have to pay even on these transactions, which will lead to certainly lead to high amount of credit for tax liability, tax collection for the government. So present amendments which are there in the e-commerce for Swiggy, Zomato, it is applicable only for the 5% category. Those entities having a accommodation facility charging more than 7,500 tariff rate will be required to charge 18% with ITC and are not covered under this notification. So impact on the restaurant is that the in-house dining will not have any impact. That means their credit, their 5% will be charged by the restaurant. If there is a takeaway, direct kitchen or cloud kitchen, here there could be an implication of this restaurant services. Home delivery, yes, there will, where it is being done through the e-commerce platform, e-commerce would have to pay the tax. where it is directly delivered by restaurant, not covered in this notification. CBSE has given a circular to clarify some of the questions which are there, but some of these clarifications are not in line with the law. So some of the issues which can arise on the concept of this restaurant service is that whether the activity is said to be a supply of goods or supply of services. And if there is separate goods and this restaurant services in the same transaction, how will be the tax implication be considered? So which means that for the goods, should the supplier pay the tax, and for the restaurant services, should the e-commerce pay the tax? So these are issues which have not yet been addressed. Where the supplies are being done through e-commerce, should it be considered as an exempt supply for the supplier? And then will there be any ITC reversal? First of all, this issue can arise even for the e-commerce because he's doing at 5%. If you see the rate notification, which is 11/2017, in the explanation, serial number 4 says that these kind of supplies where there is a conditional rate where you have 5% without ITC, such turnover has to be considered for the purpose of ITC reversal. And therefore, now does that become applicable to the e-commerce provider? This has not been clarified. But in my view, because of the fact that the supplier is actually the one providing the service, e-commerce is only liable to collect and pay the tax. He is not the person who has actually supplied it. Therefore, he will not be required to abide by that ITC reversal restriction. Now, in the event that those supplies made through e-commerce are considered in part of aggregate turnover, now for the purpose of the e-commerce, would this have to be done or should it not be considered as part of aggregate turnover? This may not be very important question, but this is a very common question in the public forums. So there is under section 34, any person who is required to pay tax under 9(5) has to mandatorily get registered. So all e-commerce must be registered who are giving these restaurant or the passenger transport services. Tax invoice which needs to be raised by the e-commerce platform and not the actual supplier where it is applicable. Restaurants who are covered under composition scheme, again the taxability for e-commerce is unclear. The circular says that these supplies made by restaurants through e-commerce must be disclosed in GSTR 1 and 3B by the restaurant, where in GSTR 1 and 3B by the e-commerce, and for the restaurant they have to show it as exempt supply. Again, this is disputable because of the fact that nowhere in the law does it say that the supplier services become exempt supply by virtue of this shifting to section 9(5). Ideally, such persons who are purely doing transactions through the delivery method or are having a total turnover less than 20 lakhs can decide to deregister from GST. Impact on the e-commerce. Now, what could be the possible impacts? TCS, which is required to be deducted for the restaurants, will not be required to be done if the tax is being paid under 9(5). Where the goods are supplied by the restaurants through e-commerce, then yes, of course, TCS would be applicable. I have answered the mandatory registration for e-commerce. Tax liability arising in the hands of e-commerce on supplies from restaurants that are unregistered under CGST Act. This is the additional liability which has been brought through this notification. E-commerce would be liable to reverse proportional ITC on his input goods or services for the reason that it is not admissible on restaurant services. So to circumvent this issue, the circular suggests that the payment with respect to restaurant services must be paid in cash and no ITC must be used to make such payments. And if that is done, then there is no need for any reversal of ITC. Actually, this suggestion is a good suggestion which has been given, but this cannot be the rule of law, because the credit which is there can be utilized for any payment, and if I have an accumulated credit, I should be allowed to use it against my cash payments. I mean, against my restaurant payment also. But if that is done, then whether there could be a ITC reversal impact, that is yet to be seen and challenged. Whether concept of composite supply arises because I'm provided now the e-commerce will be said to be providing restaurant services and the delivery or the facilitation charges. In this situation, it can be said to be no, it is not a composite supply nor a mixed supply. It is not supplied by a single person, it's actually supplied by two persons, and therefore the taxation has to be separate. It is only deemed that the e-commerce is going to collect the tax and pay it to the government. So any questions with regard to passenger and restaurant services? Mr. Manora, the protest concept you have to do through registered post. So you actually reverse the credit or you pay the tax in the GSTR-3B, and you have to write a letter that against this and this month of return, I have paid the taxes under protest. And I would, in the event that the situation is reached, the reason why you have done it under protest, then you would be claiming it back or going for a refund of taxes paid. So this is through registered post. Please do write a letter to your jurisdictional officer. Coming to governmental projects, there has been a monumental change with respect to removal of these exemptions and increasing the tax rate for the governmental authority and governmental entity. Please note, this has not been removed for central government, state government or local authority. Only for government authority and government entity it has been removed. The two types of parties have been defined. Both of them have to be set up by an act of a parliament or state legislature or established by government. They must have 90% of participation by way of equity or control. The only difference is that in governmental authority, if it is performing any function which is entrusted to a municipality under Article 243W or Panchayat under 243G, then that entity would be governmental authority. If not, that would be a government entity. So some of the general examples is Township Infrastructure Development Corporation, State Mineral Development Corporation Limited, Police Housing Corporation Limited, Tourism Development Corporation Limited. So why these have been specifically provided is that it is always very difficult to identify an entity, whether it is CG, SG, LA, GE or GA. So it is very difficult to identify, and therefore this test should be done based on whether it is set up by Act or Parliament, take their annual report from their website, go through their website, identify it established by government, and then see whether they are doing any of these specific functions. So the changes which have been made presently is that those pure services which are provided to the governmental authority or government entity, the in words have been omitted and therefore now become taxable. Pure services or composite supply of goods or services where the value of supply value of the goods which are there is not more than 25%. Even the composite supply of works contract which is supplied to such governmental authority or entity by way of construction, erection, commission of any historical monument, canal, dam, irrigation, pipeline, conduit for water supply, water treatment or sewage treatment or disposal, all of this will now be taxable at 18%. Earlier it was 12%, now it has been increased to 18%. Even the subcontract services, which was earlier under 12%, now will become 18%. Composite supply of works, which is in relation to civil structure or structure predominantly used for education, clinical or art or cultural establishments. This also has been moved from 12% to 18%, including the subcontractor services. Composite supply of works contract involving predominantly earthwork which constitutes more than 75% of the value of the works contract. This will also be shifted from 5% to 18%, including the subcontractor services. Now, the reason why this has been changed, one of the main reasons is the accumulation of credits at the supplier end, and they were going for this IDS and having a lot of issues, mainly because these are all services, and therefore, for as you know, there is a case law also on that VKC footsteps where it reached the Supreme Court, and there also it was held that the inverted duty structure is in relation to goods and that being inputs only and not the services. And in this situation, to avoid these issues, they have increased the tax rate and probably also to augment their revenue. So what is the impact of this section 14, which is for the change in rate? Because generally all these services are provided on a long-term basis, and there will be a milestone billing or a contractual basis for billing. So the rate of tax change is rule must be applied, where 2 out of the 3 rules must satisfy to ensure whether the previous tax will apply, which is either exempt 12% or 5%, or the new rate of 18% will apply. So the action points would be to review the existing tax clauses. RA bills for work done up to December 2021 must be clear, communicate and get appropriate consent, assessment of the project viability for the future, considering it now that will be at 18%. Now wherever it has become from non-taxable to 18%, their availability of the ITC on the stock of capital goods, which is there in the inventory. Procurement planning, faster utilization of ITC also is some of the benefits. Representation to government authority if in the situation it is increasing your costs to CBIC or the Ministry of Finance. There is a message, can we postpone paying input to supplier unless it reflects in 2B? You will have to go through your contract with the supplier and ensure that the you are not breaching those contracts, because there are other laws other than GST under which he can raise an issue. But ideally, ensure you get into a certified 25% agreement itself, wherein 25% will be paid only after it reflects in 2B. So taxation on textile products and footwears, the rate has increased from 5% to 12% on ready-made garments, churidar, saris, apparels, where the sale value is less than 1,000 rupees. Few of the product rates have been reduced from 18 to 12% to align the tax collections. The rates is the synthetic yarn and artificial yarn. GST rate on job workers on the printing of the said textile and textile products also has been increased from 5% to 12%. Same activity which is done for an unregistered person, which means job worker is registered but the principal is unregistered, that would be 18%. This was brought in with a view to avoid again the inverted duty structure refunds and the issues which are arising with respect to the same. But all of these decisions have been deferred through the 46 GST Council meeting due to various representations which are received from the trade and industry. The tax rate on footwear of sale value not exceeding 1,000 per pair has been increased from 5% to 12%, which is effective from the 1st of January 2022. So with this, I have completed the updates which are there for January 2022. There are certain important decisions which we can go through. I have 15 minutes, but if there are any questions with regard to my presentation,
And you have seen, no? There are 5 questions. Out of that, you said the latest one.
I have answered all of these, sir.
You answered all. Okay, fine.
Yeah. 636 also is there.
Yeah, that I am not able to see. Maybe directly shoot it to you.
Yeah, I am able to see.
Okay.
So I have a question. Could you explain government authority again? Okay. So So, Mr. Naveen, I'm hoping that you are asking about this one. So governmental authority, which is there, is coming, the means an authority or a board or any other body set up by an act or parliament or a state legislature, established by any government. Now, just these two line items uh, mean that an entity which is there to be satisfying the definition of governmental authority must have been set up by an act of parliament, which means there should have been an entry in the official gazette, there should have been an act, or there should be a specific state legislature for creating this entity, or it should have been established by a government with 90% or more of participation by way of equity or control. This details you will get from the annual report of that entity. Ideally, you go to the website. They will have a government website where you can go and get these details. Whether it is satisfying the functions entrusted to a municipality under 243W, this will not be specifically provided that they are doing that activity under 243W, but it can be identified based on what that entity does will be there in the annual report. The Article 243 has a specific list of activities which are there. There is also one CBIC flyer on the 243W and 243 list of services. You can just Google that and you'll get that flyer. Then you can check against that flyer whether that that entity is carrying out any such specific functions and it is satisfying the above set up by a parliament or government. Then you can identify that to be a governmental authority. If it is not following those functions, then it would be a governmental entity. If in the event that you are unable to identify whether it is set up by an act of parliament or state legislature, or it is not established by any government, but in your mind or in your view, it seems to be a government related entity, then it is always suggested to download that annual report, get into the basics, go into their website and see certain reports or information about us or something in that nature to identify and get some clues on how to identify this. Now, this is a very important exercise, not just for these rate changes, but also for the fact of that reverse charge applicability. There is a reverse charge applicability for services provided by the central government, state government, or local authority. In that situation, it is liable to reverse charge. But in the event it is provided by governmental authority or government entity, there is no liability. And majority of these charges ideally come from these governmental authority or entities against which many entities are paying the reverse charge. So the ability to identify, classify these entities separately can help in even reducing the cost. I hope I've answered your question. Where can we get this PPT? Shetty sir, would you like to answer that? Hello. I have shared the PPT with the organizers, maybe a little late, maybe around 3 o'clock or 4 o'clock today. I shared the PPT, but I think this can be made available.
It will be uploaded in our website, which you can download.
Yes. Yes. Okay. Then the question is answered. So I'll quickly run through some of the important case laws which have recently been released. One is the VKC footsteps. Earlier, there was a Gujarat High Court which said that the refund on GST of input services in the inverted rate structure is also allowed, although there was a contrary ruling in Madras High Court. The matter went to Supreme Court, and the Supreme Court held in favor of the Madras High Court, saying that the credit is allowed only in case of refund is allowed only in case of the inputs. And the challenge on the Rule 85 on the grounds that 54(3) is ultra vires the act is not substantial and it lacks substance. The absence of the words as may be prescribed does not preclude that the rule making authority is allowed to carry out the functions of the act. Another one is ITC is not deniable on the normal loss under section 117(5), which means that manufacturing normal loss does not require a credit reversal, but abnormal loss probably would require a credit reversal. Incorrect location of purchaser, which is UP instead of AP, was uploaded in GSTR-1, rectifiable and entitled to avail ITC. This would have been on the basis of procedural lapse rather than all the other intentions would have been satisfied. Tax evasion cannot be presumed merely on account of expiry of e-way bill. All the details must be verified. Time limit for applying for refund does not apply when the collected amount is unconstitutional and not considered to be a tax, cost small energy. So this is one very important thing, because there are many entities who are paying taxes on the basis of their understanding of the erstwhile laws, and in GST it may not be payable at all. For example, I have paid the GST on the recovery on the notice pay, which is being done. Now that is not payable in my view, and there are certain case laws also now presently which are coming up, advanced rulings, and even in service tax there were such that rulings. But the fact is that if it was not payable at all, say for example exports, it's a very good example. I am doing an export. For some reason I have thought that that activity is export or service is not an export or service, and I have been charging tax. Because of the fact that it is an export, it is outside the jurisdiction of the GST Act itself, and therefore it is unconstitutional and cannot be charged. So the time limit of refund would not apply, and I can go back and claim the credit for even 6-7 years. Credit ledger cannot be blocked in lieu of recovering the dues from the supplier. Very common High Court decision in the recent past, because of the fact that they are blocking the electronic credit ledger on flimsy grounds, and sometimes they are not unblocking the ledger even after the expiry of 1 year. For those also there are cases. Benefit of extension of time which is granted by the Supreme Court would apply for the refunds too. Yes, recently also there has been extension due to COVID. ITC cannot be denied if all the purchases and transactions are found to be supported by valid genuine transactions, and the same are made before the cancellation of registration of the supplier. Rule 97A, which permits manual refund filing, prevails over Master Circular 125/44/2019, where according to which the refunds have to be filed online. So again, sir, this is one very important concept. I think someone had asked me about this concept of under protest. So this concept of permitting to file manually, although it is not there anywhere in the law, the courts have allowed it because of the concept of principles of natural justice. If I am not able to file that refund claim online, I should be allowed to file it manually, even though it's not written anywhere. This is similar to an unwritten rule. Similarly is that under protest. Up to 7,500 exempt means only excess amount to be paid. Like I mentioned, 12,000 in example, only 4,500 needs to be paid. Up to 7,500 would be exempt. Refund cannot be denied merely on the grounds that investigation is pending, and therefore they have to process and identify if their refund is actually eligible and provide the same. Assessee can be summoned only as a last resort, and as far as practicable, details can be obtained by the assessee by an ordinary letter. Summons cannot be issued to coerce and pressurize the assessee. This is happening in certain cases, and therefore such case laws will help in ensuring that the department doesn't take the taxpayer for a ride. Authority should ensure that the taxpayer is left in a position where he can continue with his business, because it is only if the dealer continues with the business that he would be in a position to generate revenue and pay the taxes. Bringing the business of a dealer to a halt does not in any manner serve the interest of the revenue. So this concept of interest of the revenue can be read in such a manner that it should not be bringing the business of a dealer to a halt. So if you attach his property and you attach his credit ledger, do not allow him to use it. If that is bringing his business to a halt, these kind of case laws can be used. There's a very old saying which says that taxation should be done in a manner how the bee collects the nectar from a flower. It does not kill the flower, but it takes only to the extent that it needs, and the flower still flourishes and lives on. So this concept is what I think is being brought out through these judgments. So with this, I have completed the session 5 minutes in advance. I will be ready to take any questions if there are any more. If not, we can conclude the session.
No other pending question, Akshay.
One question has come, sir. Can you throw some light on textile and footwear industry rate hike? So textile and footwear industry rate hike has been brought in because of the fact that the raw materials are at a higher rate and the finished product was at a lower rate. So this was leading to a lot of this inverted duty structure, wherein the input services related also was being part of this credit. So to ensure that the inverted duty structure is reduced and the cost of the assessees does not increase substantially, and the fact that they do not need to be forced to go in for a refund and then do all that documentation and wait for the refunds, they have enabled that through this rate increase. In my view, it is not a very bad decision, and this can help the industry. But those persons who are actually getting their refunds and were able to bifurcate their credits and apply for refund genuinely and correctly, it would be it would have been useful if it was the previous rate. Yes, it is deferred through the 46th council meeting. I think only footwear below that 1,000 rupees has been kept. Sir, they are asking where in ICA website can I get the PPT?
Resources.
Resources. Okay. Probably it won't be updated immediately, no, sir?
Yeah, it takes 2 3 days time or 4 days time. Maybe next week they can check it.
Fine, sir. I would like to thank all the participants for patiently listening, and quite a lot of questions were there. So thank you for this.
Thank you.
We can conclude the session, sir. Thank you.
Yeah,
sir.
thank you, Akshay. We had a fabulous session. I think you answered all the queries. Definitely the participant enriched from this session. Thank you. Over to Divya.
So, dear members, I take this opportunity on behalf of Bangalore branch to present formal vote of thanks for today's program. Wholehearted thanks to CA Akshay Hiregange for sparing your valuable time and giving an excellent presentation. Thank you so much, Akshay, once again on behalf of all the participants and also on behalf of entire managing committee of Bangalore branch. Thank you all the participants for the active participation. I request all of you to kindly visit Bangalore branch website for further programs. Thank you, Chairman, sir.
Thank you all. Bye-bye. Good night.
Thank you all. Good night.